What if the most dangerous risk in today RS markets isn't T, the one everyone argues about online, but the one quietly growing in the background ignored because it doesn't show up in daily stock prices or trending headlines, even though it could reshape the entire financial landscape? Most conversations obsess over interest rates, inflation prints, or whether stocks are expensive, but in my opinion, those debates miss the deeper tension building inside the financial system, where pressure is accumulating in places that look stable only because problems are being delayed, not resolved. I'm not here to predict a market crash or tell you to sell everything tomorrow because markets rarely move on neat schedules. And anyone claiming perfect timing is guessing, not analyzing, which is why understanding patterns matters more than chasing dramatic predictions. The real goal is recognizing where stress is hiding, how leverage is being masked, and why some experienced investors sound more uneasy now than before past crises, not because history repeats exactly, but because the system learned how to disguise risk. Many people remember the last major financial crisis as a housing story about bad mortgages and reckless borrowers, but that explanation barely scratches the surface and ignores the deeper structural failure that allowed risk to pile up unnoticed across the system. The true issue back then was interconnected leverage, opaque financial products, and the assumption that risk had been safely distributed, when in reality it was concentrated in places nobody was properly monitoring or fully understood. Today, the pressure point isn't suburban housing, but commercial real estate, private lending, and financial balance sheets that appear healthy, mainly because losses haven't been officially recognized or forced into the open yet. Office buildings are a clear example, with national vacancy rates hovering around 20% and even higher in certain cities, reflecting a structural shift in how people work that hasn't fully been priced into property valuations. At the same time, an enormous wave of commercial real estate debt is coming due, with roughly $957 billion maturing in 2025 and another $663 billion rolling over in 2026, nearly half held by banks. When these loans mature, they must be refinanced or paid off. But refinancing today often means higher interest rates and lower property values, creating a math problem that many borrowers simply cannot solve without major concessions. Instead of forcing defaults, lenders have relied on extensions, restructurings, and accounting flexibility to delay recognizing losses, a strategy that keeps balance sheets calm for now but does nothing to repair the underlying economic damage. That's why rising delinquency rates in commercial mortgage-backed securities, now around 7.29%, are important signals, showing that cracks are forming even with every effort to keep problems contained. This situation feels familiar because frozen crises often look calm on the surface, with losses hidden by optimism and accounting assumptions, until confidence suddenly breaks and forces reality into the open. Commercial real estate, however, is only one piece of a much larger puzzle involving how risk migrated after regulators tightened rules on traditional banks following the last financial crisis. Stricter capital requirements made banks safer in a narrow sense, but risk doesn't disappear when regulated. It simply moves to areas with fewer rules and less transparency. Over the past decade, massive amounts of lending activity shifted into the shadow banking system, institutions that perform bank-like functions without being regulated like banks. By late 2025, this shadow system held approximately $256 trillion in assets globally, representing more than half of all financial assets worldwide. One of the fastest growing segments inside this shadow system is private credit, which expanded from roughly $40 billion in 2000 to nearly $2 trillion today. Hundreds of new private credit funds launched in just the past few years, fueled by investors searching for yield and companies seeking financing outside traditional banks. The concern is not that private credit exists, but that it operates largely in the dark, valuing loans using internal models instead of transparent market prices. Borrowers in private credit deals often carry heavy leverage, commonly around 7 times earnings, leaving very little margin for error if profits fall or interest costs remain elevated. On paper, everything looks stable, but the true risk only becomes visible when stress forces assets to be sold or loans to default simultaneously. What worries me most is how tightly this world is connected back to traditional banks through credit lines and indirect funding relationships. Banks have extended roughly $95 billion in committed credit lines to private credit funds, while total lending to non-bank financial institutions reached about $1.14 trillion. This category has been the fastest growing area of bank lending for years, meaning banks are exposed even if risks don't appear directly on their balance sheets. So when people say banks are safer today, they're partly right, but they're ignoring how deeply interconnected the system remains beneath the surface. The consumer side adds another layer of fragility, with U.S. credit card balances reaching $1.23 trillion by the third quarter of 2025. That figure represents the highest level ever recorded, reflecting how households increasingly rely on expensive debt to maintain living standards. The average household now carries around $9,300 in credit card debt, often paying interest rates near 22%. These numbers matter because they show financial stress building unevenly, with wealthier households spending freely while lower-income consumers struggle to keep up. This creates an economy that looks strong in aggregate but is fragile underneath, because spending depends heavily on asset prices and credit availability. When consumption is driven mainly by the wealthy, any decline in markets or asset values can quickly ripple through the broader economy. This connects directly to stock markets, especially the dominance of technology and artificial intelligence-related companies. Artificial intelligence is real and transformative, but bubbles are not about whether technology is useful. They're about whether expectations outrun reality. A small group of AI-focused stocks now accounts for more than 1/3 of the S&P 500 AS total market value. Estimates suggest that investments related to artificial intelligence drove over 90% of U.S. GDP growth in early 2025. That level of concentration signals an economy standing on one leg, highly vulnerable to disappointment or slower than expected growth. When markets depend on one theme to support everything else, they become extremely sensitive to changes in sentiment. To be fair, there are mitigating factors that didn't exist before past crises, including stronger bank capital positions and more experienced regulators. Stress tests suggest large banks could withstand severe downturns, and central banks have more tools than they did decades ago. These improvements matter, but they don't eliminate risk. They simply change where it accumulates and how quickly it can spread. One lesson from recent years is speed, as financial stress now moves in days instead of months due to digital banking and social media. Bank runs and market panics can escalate almost instantly, leaving little time for slow, orderly responses. That means waiting for obvious warning signs is dangerous because by the time panic is visible, it's often already too late. Rather than trying to predict timing, the smarter focus is personal resilience and preparation. That starts with managing your own balance sheet, controlling debt, maintaining emergency savings, and not assuming income or asset values are guaranteed. Real diversification matters, not just owning many stocks that all move together during stress. Liquidity is undervalued during good times, but becomes priceless during downturns, providing flexibility when others are forced to sell. Cash may feel unproductive in rising markets, but it offers options that leveraged investors lack when conditions reverse. Most people ignore these risks when markets are calm, then panic and make poor decisions when volatility suddenly spikes. Paying attention early allows thoughtful adjustments instead of emotional reactions. I'm not saying a crisis is inevitable, but I am saying pressure is building in places that receive very little public attention. History shows that when risk concentrates quietly, the people who understand it early retain choices. Those who remain unaware often react too late, absorbing losses they never anticipated. Financial crises are not just market events. They affect real lives through job losses, reduced opportunities, and long-term economic scars. Ordinary people typically bear the heaviest costs, while institutions with resources and access receive protection. That imbalance is not a political argument. It's simply what history shows happened before. Understanding these dynamics is not about fear, but about awareness and preparation. Information creates optionality, allowing individuals to make decisions rather than being forced into them. The most dangerous assumption in finance is believing that this time is fundamentally different. Systems change, regulations evolve, but human behavior and incentives remain remarkably consistent. Excess leverage, hidden risk, and overconfidence tend to resurface in new forms. Today, those forms include commercial real estate stress, opaque private credit markets, and extreme concentration in equity markets. None of these guarantee disaster, but together they create vulnerability. Ignoring them because markets are rising is how people get blindsided. Preparation doesn't require dramatic moves, just thoughtful adjustments and realistic expectations. Ask yourself how your finances would handle a recession, a job loss, or a market downturn. If the answer makes you uncomfortable, that discomfort is useful information. Financial strength is built during calm periods, not during emergencies. Staying informed without becoming obsessive is a skill worth developing. Watching trends, understanding incentives, and questioning narratives can protect you from complacency. Markets reward optimism in the short term, but punish ignorance in the long term. The ability to think independently becomes more valuable as conditions grow more complex. This is why long-term thinking matters more than reacting to daily headlines. The goal is not to predict collapse, but to avoid being fragile when stress arrives. Fragility is what turns ordinary downturns into personal disasters. Resilience gives you time, choices, and perspective. That advantage compounds over years, even if no crisis ever materializes. Paying attention is not pessimism, it's responsibility. The future will always surprise markets, but preparation reduces the cost of surprise. Understanding where risks are hiding gives you a clearer lens on financial news. It also helps you filter noise from meaningful signals. Markets may continue rising, or they may not, but risk awareness remains valuable either way. The worst position is being confident without understanding why. Thoughtful skepticism is healthier than blind optimism or constant fear. In finance, survival often matters more than short-term outperformance. Avoiding catastrophic mistakes creates space for long-term success. If this kind of analysis helps you think more clearly about money, staying engaged is worthwhile. I'll continue sharing insights focused on awareness, preparation, and independent thinking. Subscribe to the channel if you value clear analysis over hype and want to stay informed as markets evolve.